If you have a US company and you're selling a product to customers outside the US, there's a good chance you're missing out on a substantial US tax savings with what's called the IC disc. Not many people have heard of the IC disc, and that's what I'm going to talk to you about today, is how do you qualify for this export tax incentive? Who does it apply to? Who does it make sense for? What is the actual tax savings? And then practically, how do you file that tax return, get the qualified IC disc status, and get those tax savings? The IC disc stands for Interest Charged Domestic International Sales Corporation. It's a mouthful, which is why basically nobody calls it by its full name, but it's been around basically since the 60s. And what it is it's a specific export tax incentive that was created by the US, incentivizing people to manufacture products in the US and sell them abroad. How it works and the qualifications are essentially you have to have a US manufactured or grown product, and it has to be sold for ultimate use outside the US. So the obvious examples are a US manufacturing company, or even like a farmer growing a crop in the US and selling it outside the US. That would qualify. But more often where I see it are people that kind of fall into the nuances of this rule. So it also applies to resellers. So for example, farm equipment that maybe you don't manufacture it, but you purchase that farm equipment and sell it outside the US. That's still a US produced product, even though you didn't produce it, and you just exported it to a foreign customer. I have a client that's an artist. So they're based in the US. He paints paintings and creates art in the US that he sells to foreign people. That is a US created product that's sold outside the US. So any product like that, and also services related to those products, can be added to that. Exported US products, there's a good chance we can find a way for it to qualify for the IC disc. Now, what is the benefit and how does this work? So generally when I am working with clients with the IC disc, they are set up as an S Corp or a partnership, so a flow-through entity in the US. So let's say we have our S Corp or partnership and it's selling products abroad to a third party. So those export sales are going out to a third party. When you set up the IC disc, it's a separate corporation and you pay a commission to that IC disc, which is a calculated formula that's related to the export sales. So generally when we have common ownership, so we have individual here that's going to own both of these companies 100%. So generally in this scenario, we have common ownership with two different taxable entities. So we have to have transfer pricing set up. We're not allowed, this price right here is generally going to have to be at arm's length. So what two companies would charge each other on the open market if they were third parties. What the IC disc rules do is it relaxes these transfer pricing rules. So there is no transfer pricing. Instead, applies a different type of calculation. So you can either use 4% of the gross export sale or 50% of the net income from that export sale to derive your commission. So, and then once you have a commission, the whole game and the benefit of the IC disc is that you're converting what would otherwise be taxable income taxed to this individual at their tax rate, which could be as high as 37%. You're converting that income into qualified disc income, which then comes up to the individual as a dividend. And that's a qualified dividend taxed at the lower qualified dividends rates. What you're converting is income taxed at 37% to income taxed at the lower qualified dividend rate of 23.8%. And I'm adding 3.8% for the net investment income tax that may be applicable. But let's walk through how those formulas actually work. So to figure out what your benefit is from an IC disc and who this can apply to based on your profit margins, first let's walk through what the benefit calculates out to. So like I said, if you did not have the IC disc and you have an S Corp or a partnership, that income is going to be taxed at 37%. But there's also currently a qualified business income deduction of 20% that's applicable to most flow-through entities. So when you multiply these together, you get a 29.6% rate. This is the rate that you'll effectively be paying on this export commission income if you do not have the IC disc. So the IC disc allows you to convert this rate to the qualified dividend rate, 23.8%. So what this means is that we're getting a benefit of the difference between the two, 5.8%. So you have a 5.8% benefit in savings from using the IC disc. And so if you think about it, if you need about $500,000 of net income on your export sales for this to really start making sense. So let's say you have $500,000 net income from your export sale. That's going to save you $500,000 times that 5.8%, $29,000. So that's the benefit that you're getting from the IC disc on $500,000 of net export sales. This 20% qualified business income deduction was created during the Tax Cuts and Jobs Act in 2017, and it's set to expire in 2026. So if this provision expires and is no longer available going forward, this benefit just changed. So instead of a 5.8% benefit, we're looking at 37% versus the 23.8%. So that benefit difference is 13.2%. So now on $500,000 of net commission income, we now have a benefit of $66,000. So you can see how the benefit can jump significantly depending on whether this qualified business income deduction stays around. And that's a lot of the reason why you don't hear about the IC disc as much right now, is because of this QBI deduction kind of watering down the benefit. But not only does the benefit exceed, but also it will take less commission or less export sales for the IC disc to be relevant going forward. But either way, it's a benefit that's just sitting there to be had if you're not using it right now and you have export sales. So let's walk through an example with actual numbers just so you can see what that benefit looks like. So let's say your gross export sales is $2 million, and then you have expenses and the net export sales on that is $1 million. So you have a 50% profit margin on your export sales. The IC disc rules allow you to calculate that commission amount, which is ultimately where your benefits derive from, in one of two methods. So one is the 4% method of gross, and the other is your 50% of combined taxable income. So the 4% method takes 4% of your gross export receipts. 4% of your $2 million is $80,000. And the 50% method is going to get you 50% of your net combined income. So that's $1 million. So here, that's $500,000. So you can see in this case, what you do is you get to choose which one benefits you more. So in this case, we're obviously going to go with the combined taxable income of $500,000. And then from there, we're going to pay that commission over to our IC disc, and it's going to convert that income that's taxed at the 29.6% to qualified dividend income coming in at 23.8%. And so that's going to save us 5.8% on this $500,000, which we've talked about earlier, is about $29,000. So the benefit for a very simple transaction is pretty significant. And as your combined taxable income increases, the more profitable you are on your export sales, the more that benefit's going to be there. And so practically how that works is you need to pay an actual commission amount. So the commission we come up with here, the $500,000, that's a check you write to the IC disc. The IC disc has its own bank account. It writes a check back to the S corporation. The S corporation actually gets an expense, so a deduction for that $500,000 that went out as a commission expense. And then it comes back as a dividend income and goes on the personal tax return as a taxable dividend. At the end of the day, if you have sales outside the US to export customers, you need to be looking at to see, do you qualify? Is what you're selling qualified property? That's step one. If it is, then you need to look at what is the profitability of those export sales to see if this 5.9% that we're talking about, 5.8% benefit, if that's really worth it at your level of export sales, or do you expect it to be in the future? And if so, you can contact me or somebody that works with IC disc regularly to get it set up and then account for that commission and everything going forward. There are specific, checklist type things that you need to keep in place for the IC disc to keep it in effect year on year. But there's an actual election you make, and then going forward, it's very easy to maintain, and it has its own tax return every year. So if you have export sales, if you're selling things to customers outside the US, check out this IC disc, look into it, see if you think you might qualify. If we can help you, reach out to McGowanTax.com and schedule a consultation.